Last week something happened that has not happened in 30 years. For the first time since 1996, central banks around the world now hold more gold than US Treasury bonds in their reserves. Let me say that again because this is important. The institutions that control the money supply of entire nations, the People's Bank of China, the Reserve Bank of India, the Central Bank of Brazil, and dozens of others, have been quietly, systematically shifting their reserves away from American government debt and into gold. Gold reserves held by foreign central banks have now surpassed their US Treasury holdings, reaching approximately $4 trillion versus $3.9 trillion. This is not speculation. This is not opinion. This is data from the World Gold Council and the International Monetary Fund. And it raises a question that should concern every person who earns, saves, spends, or invests money in any currency anywhere in the world. Why? Why are the most sophisticated financial institutions on the planet, institutions with armies of economists, access to classified intelligence and responsibility for trillions of dollars, why are they abandoning the asset that has been the foundation of global finance for 50 years and replacing it with a metal that pays no interest? Over the next several minutes, I am going to explain exactly what is driving this historic shift. I will show you the numbers, I will break down the mechanics, and by the end you will understand not just what central banks are doing, but what it signals about the future of money itself. Stay with me. This matters more than you might think. Let us start with the basics. A central bank is the institution that manages a country's currency, money supply, and interest rates. The Federal Reserve does this for the United States. The European Central Bank does it for the Eurozone. The Bank of Japan does it for Japan. Every central bank holds reserves. Think of reserves as a savings account for an entire nation. These reserves serve several purposes. First, they provide stability. If a country's currency comes under attack, if investors lose confidence and start selling, the central bank can use its reserves to buy that currency and support its value. Second, reserves facilitate international trade. When a country imports oil or exports cars, those transactions often settle in foreign currencies. Reserves make this possible. Third, reserves provide security. In times of crisis, war, pandemic, natural disaster, a country with strong reserves can pay for essential imports and maintain economic stability. For decades, the preferred reserve asset was the US dollar, usually held in the form of US Treasury bonds. The logic was simple. The United States had the largest economy. The dollar was used in most international trade. Treasury bonds paid interest, and the American government had never defaulted on its debt. But something has changed. Since 2022, central banks have purchased over 3,000 tons of gold, more than any three-year period since the 1960s. In 2022, central banks purchased 136 tons of gold. In 2023, they purchased over 1,000 tons. In 2024, they purchased 144 tons. This represents roughly 25% of total global gold demand. And in 2025, despite gold prices soaring to record highs above $4,600 per ounce, buying continued. Central banks added an estimated 815 tons to their reserves. Let me break this down by quarter so you can see the pattern. In the first quarter of 2025, central banks purchased 244 tons, strong but slightly below the same period in 2024. In the second quarter, purchases dipped to approximately 170 tons as gold prices reached new highs and some buyers paused. In the third quarter, buying rebounded to 220 tons, a 28% increase from the prior quarter. This rebound occurred even as gold prices continued climbing. By October 2025, monthly purchases hit 53 tons, the highest single month of the year. November saw another 45 tons added. What this tells us is that central banks are not deterred by high prices. They are strategic buyers with long-term objectives. Short-term price fluctuations do not change their fundamental calculus. Poland alone added 95 tons to its reserves. Kazakhstan added 49 tons. Brazil added 43 tons. Turkey continued its buying streak that has now lasted over 26 consecutive months. China's central bank extended its gold buying streak to 14 consecutive months. By December 2025, this is not normal behavior. In the decades following the end of the gold standard in 1971, central banks were net sellers of gold. They viewed it as a relic, an outdated asset that paid no interest and cost money to store and secure. The reversal that began around 2010 and accelerated dramatically after 2022 represents one of the most significant shifts in global finance in a generation. To understand why this matters, you need to understand the history. From 1971 to around 2010, central banks were net sellers of gold. Western European central banks in particular sold thousands of tons. The Bank of England famously sold half of Britain's gold reserves between 1999 and 2002, at prices below $300 per ounce. In hindsight, this was one of the worst financial decisions a government has ever made. The argument for selling was that gold was a dead asset. It paid no interest. It cost money to store and insure. Treasury bonds, on the other hand, paid interest and were backed by the full faith and credit of the US government. This logic made sense in a world of low inflation, stable geopolitics, and unlimited faith in American financial institutions. That world is gone. Central banks now recognize that gold offers something Treasury bonds cannot: independence from the issuer. Now let me tell you why this is happening, and I promise you the reasons will make complete sense once you understand them. The first reason is something called de-dollarization. De-dollarization is exactly what it sounds like: reducing dependence on the US dollar. For context, let me give you a number. In 1999, the US dollar represented 71% of global foreign exchange reserves. Countries held most of their savings in dollars. Today, that number has dropped to approximately 57%. That is a 14 percentage point decline in roughly 25 years. And while 57% is still dominant, the trajectory matters. Central banks are actively diversifying away from the dollar. Why? The answer became crystal clear in February 2022. When Russia invaded Ukraine, the United States and its allies did something unprecedented. They froze approximately $300 billion in Russian central bank reserves held in Western financial institutions. Let me explain what that means in practical terms. Russia's central bank had accumulated hundreds of billions of dollars in foreign exchange reserves, money it earned from selling oil and gas, money it could use to defend its currency, pay for imports, and manage its economy. When Western governments froze those reserves, Russia lost access to its own savings, overnight, with no recourse. Now, I am not here to debate whether that action was justified. What matters for our discussion is what happened next. Central banks around the world watched this unfold, and many of them asked themselves a question: if this can happen to Russia, could it happen to us? The answer clearly is yes. Any country that holds reserves in dollars, euros, pounds, or yen, any currency controlled by Western central banks, is exposed to this risk. If that country does something that the United States or Europe disagrees with, its reserves can be frozen. Gold cannot be frozen. Gold held in a country's own vaults is outside the reach of foreign governments. It has no counterparty risk. There is no issuer who can default. There is no government that can sanction it into worthlessness. Let me give you a concrete example of how this plays out. Imagine you are the central bank governor of a mid-sized emerging economy. Your country has $200 billion in foreign exchange reserves. 80% of that, $160 billion, is held in U.S. Treasury bonds stored in accounts at the Federal Reserve Bank of New York. Your country has good relations with the United States today. But what about in 5 years, 10 years, 20 years? Geopolitics is unpredictable. Trade disputes escalate, political leaders change, alliances shift. If your country ever finds itself on the wrong side of American foreign policy, whether through your own actions or simply through changing global dynamics, you face the risk of losing access to your national savings. For a central banker, this is an unacceptable risk. Your job is to protect your country's financial stability. You cannot fulfill that mandate if your reserves can be frozen by a foreign government. Gold solves this problem. When you hold gold in your own country's vault, in your own central bank building, under your own control, no foreign government can take it from you. Short of physical invasion, that gold is yours. This is why the term seizure-resistant asset has become common in central banking circles. Gold is the ultimate seizure-resistant asset, and the shift in behavior has been dramatic. Before 2022, only about 50% of central banks stored their gold domestically. The other half stored it abroad, mainly in London and New York. Today, that number is reversing. Central banks are not just buying gold. They are physically moving existing gold from foreign vaults back to their own countries. This is a profound statement about the state of international trust. This is why J.P. Morgan, in their analysis of the gold market, explicitly connected de-dollarization to concerns about America's standing in the world. Increased polarization in the U.S. could jeopardize its governance, which underpins its role as a global safe haven. That is one of the largest banks in the world, saying in writing that American political instability is driving central banks away from American assets. And the numbers confirm this. Emerging market central banks, particularly China, Russia, India, Turkey, and the BRICS nations more broadly, are leading this shift. These are countries that may find themselves at odds with Western foreign policy. They are reducing their vulnerability. The BRICS bloc, Brazil, Russia, India, China, and South Africa, now controls approximately 50% of global gold production. These 5 countries have accounted for over half of all central bank gold purchases between 2020 and 2024. Their combined gold reserves now exceed 6,000 tons. Russia alone has accumulated over 2,300 tons. China has accumulated over 2,300 tons. India holds more than 800 tons. These are not random purchases. This is coordinated strategic behavior. The BRICS nations have been explicit about their desire to reduce dollar dependence. They have discussed creating alternative payment systems. They have increased the share of bilateral trade conducted in local currencies. They have explored the possibility of a common BRICS currency backed by commodities. While a BRICS currency has not materialized and faces significant practical obstacles, the intent is clear. These countries want alternatives to the dollar-based financial system. Gold is central to that strategy. It is the one asset that all parties can agree on. It is neutral. It is universally recognized. It has thousands of years of history as money. If the BRICS nations ever do create an alternative financial system, gold would almost certainly play a key role. But here is something important to understand. De-dollarization does not mean the dollar is collapsing. It means diversification. Central banks are not dumping all their dollars. They are gradually reducing their dollar share and increasing their gold share. The dollar still dominates international trade. It still accounts for roughly 88% of foreign exchange transactions. But at the margins, central banks are hedging their bets, and gold is the primary hedge. The second reason central banks are buying gold is to protect against inflation and currency devaluation. Let me explain how this works. When a government spends more money than it collects in taxes, it runs a deficit. To finance that deficit, it borrows money by issuing bonds. When the central bank buys those bonds, which is what the Federal Reserve did during quantitative easing, it effectively creates new money. More dollars chasing the same amount of goods and services means higher prices. That is inflation. Now look at the fiscal situation in the United States. The U.S. national debt is growing by approximately $1 trillion every 100 days. Interest payments on that debt now exceed $1 trillion annually. The debt-to-GDP ratio is approximately 124%. The Congressional Budget Office projects it will reach 155% by 2055. Let me put these numbers in perspective. Interest payments alone now consume approximately 23 cents of every dollar of federal revenue. That is money that cannot be spent on defense, infrastructure, healthcare, or any other government priority. It simply services existing debt. And the debt continues to grow. Every year, the United States spends more than it collects. Every year, the deficit adds to the total debt. Every year, the interest burden increases. There are only three ways out of this situation. First, the government can dramatically cut spending. This is politically difficult. Programs have constituencies. Cutting benefits is unpopular. Second, the government can dramatically raise taxes. This is also politically difficult and may slow economic growth. Third, and this is the path of least resistance, the government can inflate away the debt. Inflation benefits debtors. If you owe 100 trillions and inflation causes prices to double, you are effectively repaying only $50 in real terms. The dollars you use to repay the debt have less purchasing power than the dollars you borrowed. The United States is the world's largest debtor. Inflation helps the United States at the expense of its creditors, the countries and institutions that hold U.S. Treasury bonds. Central banks understand this dynamic. They know the United States has an incentive to tolerate higher inflation. They know that holding Treasury bonds exposes them to this risk. Gold is the hedge. These are not scare tactics. These are official projections from the U.S. government's own analysts. Central banks look at these numbers and ask, what happens to the value of the dollar over the next 10, 20, 30 years if this trajectory continues? The answer is that it likely declines, not necessarily through hyperinflation, but through gradual erosion of purchasing power. Gold has maintained its purchasing power for thousands of years. An ounce of gold today will buy roughly the same basket of goods it bought 50 years ago or 100 years ago. To make this concrete, consider the following. In 1971, when President Nixon ended the gold standard, an ounce of gold was worth $35. The average American car cost about $3,500 or 100 ounces of gold. Today, an ounce of gold is worth approximately $4,600. A new American car costs around $48,000, or about 10 ounces of gold. In dollar terms, the car is 14 times more expensive. In gold terms, it is actually cheaper. What does this tell us? It tells us that dollars have lost value. The 35 Edison of 1971 is worth less than $3 in today's purchasing power, a decline of over 90%. Gold has not become more valuable. The dollar has become less valuable. This is the fundamental difference between a fiat currency and a hard asset. Governments can print unlimited amounts of fiat currency. They cannot print gold. The supply of gold increases by approximately 1.5% per year, the amount mined and refined. The supply of dollars has increased by far more than that, particularly since the 2008 the financial crisis, and the 2020 pandemic response. When you print more of something, each unit becomes worth less. This is basic supply and demand. Central banks understand this better than anyone. They are the ones doing the printing. They see the internal projections. They know what is likely to happen. And they are responding by accumulating the one form of money that cannot be printed. The same cannot be said of any fiat currency, a currency not backed by a physical commodity. Every fiat currency loses value over time. It is the nature of the system. For central banks managing long-term reserves, savings that may not be spent for decades, gold provides a store of value that paper currencies cannot match. The World Gold Council surveyed central bank reserve managers in 2025. 84% of respondents from emerging and developing economies cited inflation hedging as a key reason for holding gold. This is particularly relevant for countries outside the United States. When the Federal Reserve raises interest rates to fight American inflation, it strengthens the dollar. For countries that borrow in dollars or import dollar-priced commodities, this creates a double burden: higher debt payments and higher import costs. Gold provides insulation from these dynamics. The third reason is geopolitical uncertainty. We live in an increasingly fragmented world. The relative stability of the post-Cold War era is giving way to something different. Great power competition, regional conflicts, trade wars, sanctions. Since 2022, we have seen war in Ukraine, escalating tensions between the United States and China, conflict in the Middle East, and the imposition of tariffs and trade restrictions across multiple sectors and regions. Let me be specific about what this looks like. The United States has imposed tariffs on Chinese goods worth hundreds of billions of dollars. China has retaliated with its own tariffs. Trade routes that functioned smoothly for decades are now uncertain. The war in Ukraine has disrupted energy supplies to Europe. It has triggered the largest military build-up on the continent since World War II. It has demonstrated that major powers are willing to use military force to achieve their objectives. Tensions in the Middle East have escalated multiple times, threatening oil supplies that much of the world depends on. The United States has imposed sanctions on more than 30 countries, affecting roughly one-third of the world's nations in some way. In this environment, central banks must plan for scenarios that would have seemed unthinkable a decade ago. What happens if there is a direct military confrontation between the United States and China? What happens if Middle East conflicts spread? What happens if sanctions regimes expand to include more countries? In any of these scenarios, the current financial system, based on the US dollar and Western-controlled payment networks, could be disrupted. Central banks need assets that function regardless of geopolitical conditions. Gold is the ultimate safe haven asset. It has no nationality. It carries no political baggage. It cannot be hacked or erased. It does not depend on any government, any bank, or any electronic system. The World Gold Council survey found that 85% of central banks cited gold's performance during crises as a highly relevant factor in their reserve decisions. Think about what this means. The people responsible for managing the financial security of entire nations, people with access to far more information than you or I will ever have, believe that the probability of future crises is high enough to justify holding an asset that pays no return, solely because it performs well when everything else fails. They are not buying gold because they expect normal times. They are buying gold because they are preparing for abnormal times. Now let me address something that might be confusing. Gold prices have risen dramatically. In 2025, gold gained approximately 67%, reaching record highs above $4,600 per ounce. Analysts project prices could reach $5,000 per ounce by the fourth quarter of 2026. Normally, when an asset's price rises, buyers become more hesitant. They wait for a pullback, they worry about buying at the top. But central banks have continued buying through the entire rally. Why? Because central banks are not trading gold, they are accumulating gold. There is a critical difference. A trader buys low and sells high. A trader cares about the price. An accumulator builds a position over time for strategic reasons. An accumulator cares about the allocation, the percentage of the portfolio held in a particular asset. Let me explain why this distinction matters. A trader buying gold at $4,600 is making a bet. The bet is that gold will go higher. If the trader is wrong, they lose money. A central bank buying gold at $4,600 is not making the same kind of bet. The central bank is building a strategic reserve. The goal is not short-term profit. The goal is long-term security. Think about it this way. If you were the Central Bank of Poland and you wanted gold to represent 30% of your reserves, and gold currently represents 26%, you need to buy more gold. It does not matter whether you think gold will go up or down in the next year. What matters is achieving your target allocation. You buy, period. This is why central bank buying has continued through the entire price rally. The strategic imperative overrides price considerations, and there is another dynamic at play. Higher prices actually reduce the number of tons central banks need to purchase. Let me show you the math. Suppose a central bank has $100 billion in reserves and wants gold to represent 20% of that. $20 billion worth of gold. At $2,000 per ounce, that requires approximately 10 million ounces, or 301 tons. At $4,000 per ounce, that requires only 5 million ounces, or 155 tons. Same allocation, half the volume. This explains why purchasing volumes have declined from the peaks of 2022-2024. Central banks are still buying, but they do not need as many tons to achieve their targets. Central banks are targeting specific allocation levels. Poland has stated it wants gold to represent 30% of its total reserves. Currently, it is approximately 26%. China's gold holdings represent only about 8% of its total foreign exchange reserves. Western central banks average much higher. The United States holds 81% of its reserves in gold. Germany holds over 70%. If emerging market central banks want to approach Western levels, they have a long way to go. At current prices, central banks do not need to buy as many tons to reach their target percentages. Higher prices mean fewer tons achieve the same dollar allocation. This is important. It means that even if buying volumes decline from the peaks of 2022, 2024, the structural demand remains. Central banks will continue buying to meet allocation targets. JP Morgan projects central bank purchases of approximately 755 tons in 2026. That is below the 1,000 plus tons of recent years, but still well above the pre-2022 average of 500 tons. Let me now talk about a trend that is accelerating: repatriation. Repatriation means bringing gold soi home. For decades, many countries stored their gold in foreign vaults, primarily in London and New York. The logic was practical. These financial centres had deep, liquid gold markets. Storing gold there made it easier to lend, swap, or sell if needed. But after the Russian reserve freeze, attitudes changed. Gold stored in a foreign country can potentially be frozen just like bonds or currency. If the United States decides to sanction a country, it could theoretically freeze that country's gold stored on American soil. 2/3 of central banks now plan to store their gold domestically. Germany began repatriating its gold from the United States and France starting in 2013. It took until 2017 to complete the process. Since then, Turkey, Poland, Hungary, India, and several other countries have either repatriated gold or announced plans to do so. China has taken this a step further. reports indicate China is seeking to establish itself as a custodian for gold held by other countries, a direct challenge to the traditional dominance of London and New York. This matters because it reflects a deeper shift in trust. Central banks are not merely buying gold, they are physically moving it away from Western control. Now, I promised I would explain what all of this means for the future. Here is what the data tells us. First, this is not a temporary phenomenon. The structural drivers, de-dollarization, inflation concerns, geopolitical uncertainty, are not going away. If anything, they are intensifying. Consider the trajectory. US debt will continue to grow. Interest payments will consume an increasing share of the budget. The pressure to inflate will increase. Geopolitical competition between the United States and China will intensify. Other countries will be forced to choose sides or to hedge their bets. The weaponization of the financial system through sanctions will continue. Every time sanctions are imposed, the incentive for other countries to diversify away from dollar assets increases. There is no obvious mechanism that reverses these trends. Second, gold's role in the global financial system is expanding. For decades, gold was marginal, a small allocation in portfolios dominated by bonds and equities. That is changing. Gold's share of global reserves has doubled over the past decade, from approximately 10% to over 20%. Some analysts describe this as a return to historical norms. Before the 1970s, gold was central to the monetary system. The transition to a purely fiat system was an experiment. That experiment is now being questioned, not by fringe commentators, but by the institutions that manage the world's money. Third, the dollar remains dominant but vulnerable. It's still the world's primary reserve currency. It is still used in most international trade. But the trend line is not in its favour. Every year its share of global reserves declines a little more. The question is not whether the dollar will collapse tomorrow. It will not. The question is what the world looks like in 20 years if current trends continue. Fourth, emerging markets are driving this shift. China, Russia, India, Turkey, Brazil, and other emerging economies are the most active gold buyers. They are building reserves that are less dependent on the Western financial system. These countries represent the majority of the world's population and an increasing share of global economic output. Their preferences matter. Fifth, price appreciation is likely to continue. When central banks are consistent buyers, they create structural support for prices. Even if buying volumes decline, sustained purchasing at elevated prices establishes a floor. Some analysts project gold could reach $6,000 per ounce by 2028 or even $8,000, $10,000 by 2030 if current trends continue. Whether or not these specific targets are reached, the direction seems clear. Central bank buying provides a bid under the market that did not exist a decade ago. So what does this mean for you? Let me be direct. Central banks have access to information, analysis, and expertise that individual investors do not. When these institutions collectively make a decision, when they all move in the same direction, it is worth paying attention. The message is clear: the world's most sophisticated financial institutions are diversifying away from paper assets and into hard assets. They are not doing this because they expect gold to generate returns. They are doing this because they want protection. Protection against currency devaluation. Protection against geopolitical instability. Protection against a financial system that may not function the same way in 20 years as it does today. Now, I am not a financial advisor, and I am not telling you what to do with your money. But I will tell you what I observe. Individual investors can learn from what central banks are doing. The principle of diversification applies at every level. If you hold all of your wealth in one currency, one country, one asset class, you are exposed to risks that may be difficult to predict. Gold is one option for diversification. It is not the only option. Real estate, commodities, foreign currencies, and other assets can also provide protection. The key is not any single investment. The key is having assets that perform differently under different scenarios. If one part of your portfolio declines, another part should hold its value or rise. Central banks understand this. That is why they are buying gold. If you are watching this and wondering what you should do, here are some concrete considerations. First, understand your current exposure. How much of your savings is denominated in a single currency? How much is held in financial assets that depend on the smooth functioning of the current system? For most people in developed countries, the answer is nearly everything. Second, consider what diversification means in this context. Diversification is not just owning different stocks. True diversification means owning assets that behave differently under different conditions. Stocks and bonds often move together during crises. Real estate depends on functioning credit markets. Cash loses value to inflation. Gold behaves differently. It tends to rise when confidence in the financial system declines. It tends to rise when inflation expectations increase. It tends to rise when geopolitical tensions escalate. This is precisely why central banks own it. Third, think about accessibility. There are multiple ways to own gold. Physical gold, coins and bars, provides the most direct ownership. You hold it, you control it. No counterparty can freeze it. The downsides are storage costs, insurance, and the potential for theft. Gold ETFs, exchange-traded funds that hold physical gold, provide easy access through a brokerage account. The largest, GLD, holds over 1,000 tons of gold. The downside is that you do not own the gold directly. You own shares in a fund that owns gold. In an extreme scenario, you could face counterparty risk. Gold mining stocks provide exposure to gold prices, with potential additional upside from operational improvements. The downside is that you are exposed to company-specific risks, management decisions, labor disputes, environmental issues, and political risks in mining jurisdictions. Fourth, consider the appropriate allocation. Central banks typically hold 10 to 20% of reserves in gold, with some holding much more. For individual investors, financial advisors often suggest 5 to 10% as a starting point for portfolio diversification. The right allocation depends on your circumstances, risk tolerance, and views about the future. There is no single correct answer. What I can tell you is that an allocation of 0, which is what most people have, ignores the signals that the most sophisticated financial institutions in the world are sending. Let me summarize what we have covered. Central banks around the world have been buying gold at historic rates for 3 consecutive years. Purchases exceeded 1,000 tons annually from 2022 through 2024 and remained elevated in 2025 despite record high prices. For the first time in nearly 30 years, central bank gold holdings now exceed their US Treasury holdings. The reasons for this shift include de-dollarization. Reducing dependence on the US dollar after the freezing of Russian reserves demonstrated the vulnerability of foreign-held assets. Central banks are also hedging against inflation and currency devaluation as US government debt grows at an unsustainable pace. Geopolitical uncertainty, including the war in Ukraine, US-China tensions and Middle East conflicts, has increased demand for safe haven assets. Emerging market central banks are leading this trend, with Poland, China, Turkey, Brazil, and Kazakhstan among the largest buyers. Repatriation is accelerating. Countries are moving their gold from foreign vaults to domestic storage. Looking ahead, projections suggest continued central bank buying of approximately 755 tons in 2026. Gold prices could reach $5,000 per ounce by year-end. This shift is structural, not temporary. The conditions driving central bank gold buying are likely to persist for years. Here is my final thought. Money is ultimately a matter of trust. We accept dollars, euros, and yen because we trust the institutions that issue them. We trust that those pieces of paper or those digits on a screen will retain their value and be accepted in exchange for goods and services. When central banks buy gold, they are signaling something about trust. They are saying, we trust gold more than we trust paper promises. That should give all of us pause. The institutions that create money are themselves losing faith in it. They are hedging. They are diversifying. They are preparing for a future that may look very different from the present. Maybe they are wrong. Maybe the dollar will remain dominant for another century. Maybe the debt will be managed. Maybe geopolitical tensions will ease. But maybe they are right. And if the people who control the money supply are buying gold, perhaps we should at least understand why. That is what I wanted to share with you today. Thank you for watching. If you found this valuable, please subscribe and share it with someone who might benefit. I will see you in the next one. Sources cited in this video.